Hello! Welcome to another video from the Red Candlestick. Yesterday we talked about US government bonds being in a bubble. Today we're going to be talking about a person that I disagree with. That person is Dave Ramsey. And the reason why I disagree with him is predominantly on his argument about debt. Now, obviously, if you listen to the last video, you might know that I have interest in not exactly the debt market, but just like the general understanding how debt affects the market. That's one of the biggest things. So the first thing, I will like to explain that just because one person has more debt than another person does not make that one person more likely to go bankrupt. Here's a great example. Turkey and Singapore. Now, if you remember, Turkey was a video in the last video for a very different reason about the government not raising interest rates and why that doesn't really make sense. But as you can see, Singapore has 109% GDP to debt to GDP ratio, and Turkey only has 31%, 31.6. Now, if you just looked at this from a debt to GDP ratio standpoint, you would think that Turkey is less likely to go bankrupt than Singapore. Now, what you don't understand is how this debt is being deployed. One thing I would like to say about Singapore is their debt has been deployed strategically to use it to build infrastructure, and that infrastructure ends up being an asset rather than a liability, like many Western nations use debt to give unemployment benefits, especially with COVID-19. So if you look at Singapore, they are rated AAA, which is the highest bond rating that you can get. Actually, for a AAA, they actually pay out quite a good interest rate. I could show another major AAA economy that does not pay that much. In Germany, another AAA, but they pay out nothing. So, Singapore is actually quite high for being AAA. The amount that they pay out. Even other countries such as let's go up here. Australia. Australia is another AAA. They pay around the same. But my point is that Singapore is quite high by world standards for a AAA. Let's go back here. And, being a AAA means that investors are more interested in investing in their economy. Even the US is not a AAA anymore. It's now a AA, and the main reason why is due to the increasing debt of the United States. If you look at Turkey, though, they are a B+, which is really bad. That's a speculative rating. That's not good at all. Especially, actually, if you go here, see, it's speculative. And by some, it's highly speculative. So very, very risky stuff in Turkey. Turkey has been very bad at handling their debt, which, if you just believe in what Dave Ramsey says, you would think that Turkey is less likely to go out, you know, because their debt is only 31%, and they have even been decreasing their debt. Turkey also pays a much higher interest rate, over like 20%, like a 20% interest rate on their debt. That is like credit card, but they also have very high inflation, and the way that they deploy their capital is not very good. So this is where debt comes into play for people, normal people, not just countries. So here is the October release of the Consumer Price Index, and we can see that inflation over the past 12 months has been around over a little bit over 6%, and the core inflation, removing food and energy, is a little bit below 5, which is quite high by historical standards. But if we look here, mortgage rates, it's about 3.1%. And the reason why I say why I'm using 30-year mortgage rates is because this is the most common way that normal Americans are exposed to debt. So, if we go back here, we see that the inflation rate is much higher than the rate that you're spending over here. Now, obviously, many assets, including real estate, which this is, mortgages are for real estate, including real estate, can also appreciate more than inflation. So if you look at the GDP growth of the US, you can see that the GDP growth has been 3.1% from 1948 to 2021. So quite a long period of time. So this data is probably pretty accurate. And if you really think about it, that is quite amazing. That means that if you look over here, US GDP per capita, we can see that over time, the US has gotten richer and richer and richer. And even if you look at the median, this is from 1984 to today, people have gotten richer. Now, obviously, there has been a lot of stagnation in wages for a while, but there has been recent increases and also some decreases, but a lot of increases in recent years out of the 2008 financial crisis, after the 2008 financial crisis. But over time, generally, even by median, this is like what normal people make. This is adjusted for inflation. This is real median household income. This is what people make over time. So it's slowly increasing over time. Over here, we can also see that the U.S. inflation rate has been at 3.93%. So, if you're wondering where the idea of getting a 7% return in the stock market, it's these two numbers added together. So let's get this right here. Yeah, and that's about 7%. So that's where the idea of getting a 7% return in the stock market. Obviously, you can get much more because they don't include the dividends that you get from the stocks, but generally this is what you should expect without dividends. If you're just investing in a normal way, now, this is where the interesting part comes in. So, if you have a 7%, actually, so let's see. If you have a 7% cap rate, 0.07. And let's think about this. Actually, never mind. We're gonna go back to here, and we're gonna go to here. So let's say you put 25,000 down. Let's say you put $25,000 on a $100,000 house, and okay, so as you can see here, you are paying $351 a month. So this is where the fun part comes in. So you get 7,000, and then 351 times 12, and then you take this, and then you take the amount that you put down, and you can see that you get a 11% rate of return, which is far better than the 7% rate of return before this. Obviously, you can do better than this quite easily, but I'm just giving you a quick idea and a quick understanding of leverage. So instead of getting 7% return, you're getting a 11% return. And even though that doesn't sound like a lot, if we go and compound interest rate, if we look up a compound interest rate calculator, so if I put, let's say we put 25,000 in, and we do that over a 30-year period, and let's say first case, let's say we have 100,000, and we get a 7% return on that 100,000. We will end up with $700,000. Now, if we put our money at 25,000 and we have 11%, that's 572,000. But that also means that you can invest your other money, and with that other 75,000 that you could have had, you could have invested that, let's say, in the stock market, and got a 7% return. So you would end up with like over $1 million. I mean, obviously that's really rough math, and that's not exactly how it works, but good understanding at a very, very low level. Basically, at the end of the day, you end up with more money at the end. Obviously, there's many different ways to even get better rates in this, and that's through studying and researching and finding better deals in whatever way that might be. But this goes back to the idea that, okay, now Dave Ramsey is right about one thing. You should not have credit card debt. Actually, what is interest rate on credit card debt? What is the interest rate on credit card debt? Chart. Okay. 16%. This is very low compared to what it usually is, but still, 16% interest rate, that is not very, and you should not even rely on your chances of getting a higher return on your money. That is something, 16% interest, that is low in credit cards. Normally they're above 20%. So, because credit cards have much higher risk, since most of the things that are spent on them do not add any value, and it's hard to use credit cards and get a better return on your money, even if you are using it in a desperate case scenario, maybe to start a business or get the last few dollars of funding for whatever, and it's very, very risky, obviously. But that is more obvious. This is more interesting. See, Singapore, Turkey. Now, I guess I could put up a... Let's think about this. What is a country that has a low... Let's see. What about Russia? Russia has even a lower than Turkey. Now, Russia, I'm pretty sure, has a better credit rating than Turkey. I would be shocked if it doesn't. It's kind of, But Russia's still questionable economy. Yeah, it's better than Turkey. I would be shocked if it wasn't. They had a really bad... They had an in default score back in 1999. If you know anything about the history of that, pretty crazy stuff. Actually, that's kind of interesting. That's one of the ones... That's something different. See, as you go up, the interest rates go down. I don't know why. That's pretty interesting, though. I'd love to learn a little bit more about this stuff. But obviously, their interest rates have been going up. Interesting. But, to get back to the point, Russia has very, very low levels of debt, but they only have an average credit score. Actually, it's slightly below average credit score. I guess future anticipation of inflation in Russia is going to be lower. That's interesting. And, yields are also going up, it seems. Yeah, they're going up. So, interesting stuff. I would have to research more about Russia. I can't really comment on that, but obviously, understanding that you can get a better return, at least currently, with debt, obviously things can change. In fact, where was that, if you look back in the video, there were times where mortgages were at like 20% interest rates. So obviously many, many things can change, and I would not I would just look at everything as a relative. You know what the expected inflation is of the US, it's about 4%, and you know that the expected GDP growth is about 3%. Now, you can do further research into local economies, into certain businesses, into certain industries, into what that exact company is doing. But, this is a basic concept to understand how debt and assets relate, especially right now, understanding that debt currently is a way to increase your return. Obviously, even though it would hurt a lot of people in the beginning, I still believe that increasing interest rates, or just letting interest rates to be free from, the actually, I think that's the best thing that could happen, is if interest rates were free, and that if they were not controlled by the Fed. But obviously that has not happened. The Fed continues to buy up them, but obviously not the best thing for lenders and savers, but it helps you get, if you understand it, it helps you get richer, since there's a massive imbalance. But I don't know how long it can continue, and I really don't, if you remember from the last video, I don't really think this can continue for forever, because obviously there are some breaking points. There are some times where some countries and some pension funds and other things might not continue to invest in the U.S. economy, and that would cause a different outcome. But at least currently, having debt is better than not having debt, if you can deploy the debt properly, as Singapore has. And that's about it.